Welcome and thank you for attending today's bi-monthly webinar for the IncomePlus Fund. I'm Michael Episcope, co-CEO and co-founder of Origin. I'm here today with David Welk, who's filling in for David Shear. David is managing director at Origin. He's been here for more than 10 years. He's been a huge part of our success at the company, and I'm excited for him to be here and share his knowledge and insights with you today. We have more than 400 attendees today. I think that's close to a record, if not a record. Most are current investors, but there are quite a number of prospective investors as well. So for the benefit of the prospective investors, I'm going to cover a little bit about Origin, what differentiates us, and then I will cover the fund's performance at a high level. And Dave's going to cover some of the individual asset performance and then the pipeline. And he'll also talk a little more about the state of the market, what's happening with commodity prices, cap rates, et cetera. And then we're going to open it up and answer questions. And I would ask that if you have questions, please put them into the Q&A, not the chat box, unless you want to send us a private message in the chat box. We have received a lot of questions in advance of this webinar, and we thank you for that. And we're going to try to get to them all during this presentation. The entire webinar is only going to be about an hour, which I would imagine about 35 minutes will be the presentation, and then the rest will be dedicated to the question and answer session. I'm going to start by just really touching a little bit. I don't want to steal Dave's thunder, but I'm going to touch on kind of the state of the markets, and really more from a strategic position and how we're adjusting our strategy to position ourselves for future success. And this is something that I mentioned on the last webinar. And just to be, kind of a little background here, the IncomePlus Fund is a multi-strategy fund. It's meant to deliver income and appreciation in a very tax-efficient manner. And the three strategies that we focus on are that we lend to, we acquire, and we build multifamily properties. And building is something that we recently added to the fund. 20% of the fund's capital can be invested in what we call a build to core. So developing with the intention of holding long-term. Having a multi-strategy fund is a huge advantage in today's market because we can adjust to market condition. And today, that's exactly what we are doing. The strength in the market that everyone is reading about, that's on every front page out there about the Southeast, the Southwest, and Texas, it's leading to valuations on existing properties that we simply can't make sense of. And so we are completely out of acquiring core plus and value add properties in this market today and focusing on the lending and the building to core. And the simple reason is that properties that are existing are just too expensive. It's where all the capital is, and what we're witnessing is 20-year-old product trading at or above today's replacement cost. And pricing simply doesn't make sense to us, so we are stepping aside. And that's a huge advantage of this fund and being a multi-strat is that, I think it was Dave brought us a deal not too long ago. It was in northern Atlanta, and we were looking at it, and it literally kept me up at night because you look at the risk reward in buying 4 caps out there, and it was a phenomenal deal and it was awesome, but it was also a core plus deal. And small, tiny changes in cap rates where you're not able to protect your equity produce large changes in the underlying investment. And that's not the kind of risk reward we're looking for. So we're really looking at protecting our capital on one side with the lending, and then also building to high margins and building quality projects to even better basis than what we could buy for in today's market through our build to core component. And the other story I'll share with you is that I was golfing with the CEO last week of a development company, and this kind of puts it in perspective what's going on in the market. And he was talking about a deal that he just sold. And it was a head-scratching price. And I asked him, I'm like, how did they make sense of that? He said, I asked the same thing. And I called up the CEO, and he said that they're underwriting 6% compounded growth rates over the next 6 years to get the deal to work. So, to put that in perspective, generally in our markets, what we're seeing is growth rate forecasts anywhere between 1% and 4% annually. So 6% is 50% higher than our highest growth rate out there. And that's just not a market we want to play in today. So we're stepping to the side. We're going to focus on the lending and build the core. And we believe that's the most responsible way to run this fund. It's not going to lead to the greatest tax efficiency, but it will lead to the greatest what I'll say, absolute returns in this fund and the greatest long-term success. I am excited to announce we've invested in our first ground up development deal in Nashville. I think Dave is going to talk about this a little bit more. So that is the first of sort of many that will go into the fund. And I'll say this, that when we're doing these ground up development deals, they typically require $20 to $25 million of capital. And so we are doing sidecar deals, and we're not marketing these broadly just because it's too much to manage when we have 500 to 600 investors in the fund who are all inquiring about the deal to our investor relations team. So the last time we were on this call, we said, if you have an interest in sidecar opportunities, please email the investor relations team, let them know in advance. And so the next deal that comes out, they'll bring it out to you and they'll show you the deal. And so we have a few deals coming out that are going to close in August, September, October, November. But the idea is that we want 4 to 5 of these opportunities in the fund to better diversify the fund into the ground up development across not only the capital, but across geographies as well. So I'm going to jump into the presentation now. Jeff, can you start the slideshow? There we are. So this is really about Origin, and most of you know our history by now, but I said I was going to go over this briefly. We've been around for 14 years. We own and control well over 9,000, even more than 10,000 multifamily units if you consider the ones that are in sort of the development stage as well. We represent close to 1,800 investment partners that include individuals, high net worth, ultra high net worth, family offices, and more registered investment advisors. So a year ago, we probably had 12 active registered investment advisors, and we have close to 30 today. So that segment is really picking up as registered investment advisors are using the IncomePlus Fund, the QOZ fund, as a solution to the real estate sleep. Now, on this page, the metric that I'm most proud of here is 0 realized losses across any of our fund deals. And the number one rule of investing is never lose money. And risk management is in our DNA. We have never lost money on a fund deal. Risk management is something we obsess over, and it shows up in this metric. And when we were doing this 14 years ago and started this company, that was really one of the things we focused on, is how do we get into great deals? How do we protect ourselves? How do we protect our capital of other people? And that philosophy is really carried into everything that we do today. When I was in grad school, I remember one of our guest lecturers saying, the key to real estate and being successful is you invest in quality, you take care of the downside, and the upside will take care of itself. And that's so true. I believe in that philosophy a lot. The last metric on this page I'm going to touch on here is really our co-investment, which translates into alignment. Us being aligned with you, our team being aligned with us, and everybody being aligned together. So we're all after the same results. And from the day we started at Origin, the company was really always about finding deals and designing funds that we wanted to invest our own capital into. That's what we've done, and that's what we continue to do. So everything we bring out to investors, we first always look at it through the lens of our own capital, because we are so much like all of you, whether you're a registered investment advisor, we're your typical client, whether you're ultra high net worth, we're all looking for the same things. We've done well in life, and we want to protect and grow our capital. And David and I have invested more than $58 million across our various funds. And our investments in our funds and deals, it's how we continue to build and grow our personal wealth. Next slide, please. There we are. So we recently discovered, we've always used Preqin as a benchmarking tool, but we recently discovered we were ranked 15th out of nearly 2,000 investment managers by Preqin. And this puts us clearly in the top 1% of managers. And this ranking, it's not about one fund, it's about consistency over time. It takes into account all of our funds as it does for other managers as well. And it was quite an honor to see this. And when we found out actually this, in the past sort of 2 weeks, I would say, but it was an RIA, a registered investment advisor, who brought this to our attention. And when we were speaking with them, we always ask people, how did you hear about us? It's nice to hear if somebody has referred us or if they, came to us through marketing. And they said that they were doing a manager search and saw that Origin was ranked 15 out of more than 1,900 investment managers. And they had seen our marketing and et cetera, et cetera. But that's how we came to know about this. So something we're very proud of. It's a testament to our investment philosophy and really our team's ability to execute. And I'd be remiss if I didn't, say a few words about the team. Next slide, please. Thank you. So we have close to 30 team members at Origin. We have 4 offices around the country. And when you invest with Origin, these are the people who work to make your experience with Origin successful. And I say experience because I know that it goes well beyond just returns. I'm in a lot of private equity. David's in a lot of private equity. And we've always believed in building the firm around the entire customer experience. And that's from onboarding to client service to reporting, making sure that somebody gets back to you quickly. Generating returns is a huge part of that. And managing those properties is a big part of generating those returns in the acquisition side. And we measure success at every touch point, from that onboarding to generating returns to managing our assets effectively. So, and what I should point out here is that the vast majority of our senior leadership team been with us more than 6 years, and several have been with us more than 10 years. And it's important to know because you are investing with the same team that has produced our past results. And this will be the same team that's responsible for producing our results in the future in this fund and other funds that we roll out as well. So I'm going to jump into now the fund overview. So next slide, please. Get into the meat of the presentation here. So we have 11 investments in the fund today. And as of the end of May, the fund's net asset value was slightly more than $153 million. Now, this is only through May because we don't have actually the information through June yet. Our accounting books haven't been closed. So, when we do this in a couple months from now, hopefully we'll have this through July. The net asset value per unit is $9.77, and that's up 1.2% from April. So quite a large jump. And that's only talking about the unit price itself. So that doesn't include the cash flow as well. So quite a big monthly change. The fund's annual distribution yield right now stands at 6.1%. So if you were to invest at $9.77, that's what you can expect to be distributed on an annual basis. Keep in mind, though, this is paid monthly, so it's about 0.5% per month that gets paid out monthly, but you can always choose the DRIP, the dividend reinvestment program, if you don't need the income. For our common equity investments, our leverage ratio has declined to around 63% versus 65% last update. And that's really a function of just marking assets up higher as we see improvement in the market. And our debt service coverage ratio sits at a healthy 1.39x. And what that means is that for every $1.39 that we produce, $1 goes to debt, and we have 39 cents left over in income. So a healthy ratio right there is typically 1.2 to 1.25. So we're sitting well above that. So we have quite a bit of cash flow to help pay the dividend. The portfolio breakdown is 47% preferred equity, 30% common equity, and 23% cash and marketable securities. And so we got some questions on the marketable securities here. And I will say that investing in marketable securities, it's not a core strategy of this fund, but managing cash efficiently is a necessary function of managing an open-ended fund, because there is a timing difference between when capital comes in and when deals close. And sometimes that timing difference is 30 days, and other times it might be 6 months. Now, at 23%, this is at the very high end of where we want to see this metric. We do have a lot of deals in the pipeline. They're going to be closing over the next several months. Our target, here would be kind of 5 to 10%. So we have capital to close future deals, but not so much that it actually impacts the return of the fund. So, again, that cash is really sitting there waiting to be deployed into deals. What we've done with the public security strategy, it essentially mirrors the strategy of the fund. So 25% of our cash is in multifamily equity portion, 40% is in preferred equity to pick up yield, and the remainder is in short duration bonds, so just something better than a cash account at bank. So we have a very diversified and balanced public securities portfolio, and it's done quite well. It's generated roughly 9% over the last 12 months and 1% per month since January. So round math, if you think about that, 20% of the fund in cash on 150 million, round up to $30 million, generating 9%, that's $2.7 million we were able to pick up in this part of the portfolio as it sits waiting for deals. So it's the optimal way to run the portfolio, and it's done quite well and certainly helped us generate some returns over this last year. Let's jump to the next slide, which is we'll talk about the fund returns. Thank you. These are our quarterly returns, and these returns are inclusive of both appreciation and cash flow. And we do send out updates on a monthly basis. The only reason why we're doing it quarterly here, I'll get into this in a second, but we are comparing this to a benchmark that only reports quarterly. And you can see that on the right-hand side here. The last 12 months, the fund is up 12.2%. That's inclusive of both the unit price change and the cash flow. Year to date in 2021, the fund is up 5%. So that's about 1% per month. That's through the end of May. And what we've done here for your benefit, and really our benefit, because we measure everything against a benchmark, is that we've adopted the NCREIF Odyssey Core Equity Index as a benchmark to our fund. And you can see that to the right of our returns. And we chose this because this index most closely matches the risk return of our fund. And this is made up of diversified properties. It's levered, but it's actually gross of fees. So in many ways, there's actually this, we're at a detriment to this fund, or not a detriment, but that's gross of fees, we're net of fees. So when we think about beating it, we want to beat any index net of fees. And the reason why benchmarking is important is because a manager's returns are always relative to the returns of an index. That's the index that's a good proxy for the market. So in other words, if we produce a 10% return, but the index produces a 15% return, that's not so great. If we produce 10% in a vacuum, you might think that's good until you realize the market's up 15%, and vice versa. If we produce a 5% return and the index is at 0%, that's a great relative return. Now, we didn't hit our pro forma there, or what we're seeking to do on an annual basis, but we are still, in many ways at the whim of a market. And this is how you produce alpha, but we want to be very transparent about how we are performing relative to an index. And everything we do at the firm, whether that's in the acquisition side or the investment management or measuring fund returns, is always relative to a benchmark, because that's the only way you know if you're beating your competition. So in this case, we've actually beaten the Odyssey Core Equity Index 7 out of 8 quarters. And the month that stands out is the COVID quarter. We were down 5.9%, while the Odyssey Core Equity Index was only down 1.6%. Now, you can see that we made up a lot the ensuing quarter there. What I did do today is I was curious about that because the way that it works when you have a large negative month, obviously losing 10% and then making up 10% is not the same thing. So, and I ran the math, and even with that quarter, we've actually produced more real wealth since inception in the second quarter of 2019 when you factor in the compounding of all the different months. So in other words, $1 invested in the IncomePlus Fund would be worth more than $1 invested in the Odyssey Core Equity Index over the same period. So let me jump on to the next slide, which is operational highlights. And I want to, this is only the common equity portion of the portfolio when we talk about operational highlights. This is 30% of the portfolio here. The black line represents revenue and the blue line represents occupancy. And you can see revenue has been roughly the same for the last few months, while occupancy has picked up substantially here. In March, occupancy was around 90%, and today we are above 93%. And 3% doesn't sound like a lot, but when you're talking about, in terms of occupancy, it's a significant amount of revenue at a property. And the difference between, running something at 91, 92, 93 can mean a lot to your bottom line. So portfolio is doing well right now. And one of the things I'll point out here is the reason why you don't see revenue keeping up or taking off with the occupancy is because some of that occupancy has been bought through concessions. And that's a fancy way of saying we give away free rent to get people in. But as that burns off, we're going to continue to see revenue increase. Obviously, like when you look at this chart, you can see that the portfolio was in a very different spot 9 months ago. And we're happy to see the trends and the results of the portfolio today. And again, big testament to our investment management team as well. All right, let me go over collections really quickly. That's the next slide here. We've been holding strong above 96%, almost coming close to 97% over the last 2 months. National average is around 94.5%. And some of that, they continue to extend this moratorium in the future. We're hoping that eventually goes away. It looks like there is light at the end of the tunnel there. I've said this before, this portfolio should be operating at 99%, even 100% in the collection side. This isn't even a metric we looked at in pre-COVID because it doesn't exist with the demographic that we're renting to. These are high income demographic renters, generally white collar jobs who really care about their credit scores. So, people are not generally willing to skip out on rent and ding their credit in an environment like this. So I believe we're going to continue to see this jump into the future, and hopefully this won't even be a slide when we report out in the future. So that's all for me. I'm going to hand this over to Dave Welk now, and he's going to talk about some of the individual assets, and then we'll open it up for Q&A. So keep the questions coming into the Q&A box, and we'll get to some of the questions that were mailed in, and then the Q&A, and then the questions that were emailed in after that through the Q&A box. So thank you very much, Dave.
Thank you, Michael. I have some literal and figuratively large shoes to fill in for Dave in his absence. But luckily, although I'm much shorter, I think we do actually have the same shoe size. So good morning, all. Happy to be with you. Let's jump right into some of the portfolio highlights. We'll start here with our first asset here, Monroe and Aberdeen. But as Michael mentioned, I'm going to provide a brief overview of our acquisition pipeline after the individual asset updates for our fund investment opportunities. And I'll spend a little bit of time going through what is our deepest pipeline to date, representing 7 deals totaling $430 million of total capitalization and $120 million of potential equity in the pipeline. So excited on the work that the team has done over the last, call it 60 days or 60 to 90 days to build that pipeline. But to get started with Monroe and Aberdeen on some of the individual asset highlights, over the quarter, we have 94% occupancy, which was in line with our comp set average. And we maintained a 1.25 debt service coverage ratio, as Michael just alluded to, an important benchmark for debt service coverage. The West Loop, notably as the submarket, has effectively eliminated concessions in combination with increase in rents, has translated into a 37% effective rent growth since January at the property. In comparison to the comp set average, the comps have increased about 23%. So a very remarkable rebound here at the property, but also in the submarket as a whole since the beginning of the year. We retained about 63% of our leases in the second quarter compared to our competitors' renewal trade out of about 50%. So another important metric to look at how well we're doing in terms of retaining our existing tenancy that eliminates downtime and removes turnover costs. So another important benchmark that we track throughout. As Michael just noted on collections, but we did actually collect 99% of billed rents during the quarter, which is in excess of the national average. And throughout the pandemic, it's important to note here that only one unit was severely delinquent, and that unit's currently in its final stages of the eviction process. Next asset, Madison at Westinghouse. This has been a remarkable performer for the fund. We averaged 96% occupancy during the quarter, maintained almost a 1.9 times debt service coverage ratio here, so well above normal. Back to our renewal trade out rents, we're able to achieve a 9% increase over the quarter, which was almost double our competition with their trade out increases on renewals of about 5%. Our retention of existing residents of this asset was about 46%, and we trailed our competition slightly, which was at 51. But we're happily taking the slight dip in our retention for, again, almost doubling up on the increase in rents that we're achieving there. Of note, there is a newly built project that was wrap construction, so slightly different, but more expensive. It's got structured parking associated with it. That was sold during the quarter at a price that exceeds our valuation by 20%. So we're achieving of note, and I'll get into this here in a second, but is the unprecedented rent growth we've seen at this asset in the last 60 days. So we're achieving new leasing velocity at 20% higher rents than our current in-place rents of the project. And in line with this project that I just mentioned, that sold at a 20% valuation above our current basis. So exceptionally strong performance as this asset. And we will, as a result of comp trades in the marketplace and increased operational performance, we will be writing this asset up in our June valuation approximately 8%. So very strong performance on this asset over the course of the quarter and really through the pandemic as a whole. Next opportunity is District at Memorial. This is one of our Houston-based asset located in the Energy Corridor Memorial City submarket. And this particular submarket has struggled a little bit during COVID, but has recovered as of late as well. And that's a broader trend that we'll touch on here towards the end of the presentation, is that over the last quarter to two, we've seen remarkable recovery in all of our markets coming out of COVID. This particular submarket was a bit of a laggard relative to some of our other markets, but we pushed up to the submarket finished occupancy at 93% at the end of the quarter, which was a significant uptick from Q1, which was 89%. Over at our asset in particular, we achieved a 1.4% increase over the quarter, while our comps were achieving about 0.5%, so almost a full percent above our competition. And we will continue to use revenue management here and focus on building the rent roll while we increase our occupancy from our COVID lows. Prior year renewal conversion here was more challenging than some of our other assets. We had a little bit higher delinquencies here and a number of residents that moved out at the end of their lease. However, in the second quarter, we achieved a 42% conversion, which is higher than our comp set, and we continue to collect about 96% of our total billings, which will push some efforts have been underway, which will allow us to increase our rents at the property over the last couple of quarters. We've been upgrading the exterior amenities and completed the rooftop renovations of the pool, installed a brand new outdoor kitchen, exterior lighting, and that will encourage year-round use of our skyline views at our rooftop pool. These upgrades were completed in time for our 4th of July events that we had planned at the project. So we've seen in toured physical or because of our improved physical aesthetic, our tour path and curb appeal of the property is enhanced, and we've seen a pickup in traffic here. So we'll continue to see uptick in performance of this particular asset. On the next slide, we'll talk about Star Metals. This is our West Midtown Atlanta-based project. Our development partner is targeting a refinance of the senior debt in the third quarter, late third quarter, early fourth. And once the property reaches approximately 50% occupancy. And at that point in time, they'll intend to utilize the refinance proceeds, and they'll redeem our entire preferred equity position of the fund. So likely that this opportunity will be removed as a fund investment towards the end of this year. Aspire Westminster, similar story here in that our development partner has procured a term sheet for a $65 million refinance of this construction of the in-place construction loan, which is anticipated to close in the third quarter or fourth quarter of this year as well, following substantial completion. So this facility would effectively retire our principal position, but not retire our preferred interest. However, our development partner has suggested that they will inject additional capital to retire our full position at that point in time. And the investment is structured with a 1.4 minimum equity multiple over a 2.5-year period that would generate a 16 to 17% IRR. So it would be a strong investment for the fund and provide us with a significant amount of capital to redeploy into new opportunities. Maple Street lease-up's underway. We're about 32% leased and 22% occupied. The final TCO, the temporary certificate of occupancy, is expected by Labor Day. The finished product here looks outstanding. There's a regional grocer here that has signed a long-term lease that will be open by the end of the year, which will provide some additional amenities for the residents above. I'm going to kind of cover in a wide swath the 3 Greenville pref deals, which is Lively Victor Park, Lively Farmhouse, and Lively Drayton Mills. Nothing of substantive to report on these projects. Really, they're all proceeding as scheduled. Everything's tracking, no major issues, so I'm not going to spend a ton of time going through those 3 particular projects. On Ashley Oaks, similarly, I'll run through that quickly as well. The interior and exterior renovations are underway. Everything remains on track. And then Haven at Mansfield, we closed on this particular project with our development partner, Geffen, and I'll spend a little bit of time talking about them in the pipeline. But that was closed again in March. We locked in lumber immediately at closing. Our development partner was monitoring the lumber market, and again, we'll touch on this on the state of the market, which has seen massive fluctuations and up until recently had only been going up, and they locked in their lumber contract immediately at closing in early March, which was a prescient move on their part because lumber at that point went on another $500, 1,000 board foot run from when they locked in. So project remains on time and on budget, and excited for that, to watch the project be move through the construction process. And we'll jump now to the next slide, which will cover the pipeline. Generally speaking, as I mentioned before, as Michael also touched on, we've got a number of build-to-core opportunities in the pipeline. These are projects that We will build, and as true to the name, we will hold them long-term until they complete the lease up, and we'll hold these opportunities as they become core assets. I mentioned before, we have 7 deals in the pipeline here that are shown on the screen. What we're showing here is the total equity amount that the fund would commit to. That's not fully accurate because, as Michael mentioned, what we will be doing is raising sidecars for a number of these particular opportunities. So the fund necessarily won't be allocating dollar for dollar what's shown on the screen, but if you sum the entire pipeline up, that's 120 million of equity, 430 million of gross capitalization. And as I mentioned at the outset, I'm really proud of what our team has done over the last, really 3 to 6 months, but this has been a several year process. If you really kind of look back on how long we have been developing these relationships with developers to put us in a position to execute on these build to core opportunities. This is going back really 3, 4, 5, 6 years in some cases of some of our partners. So the groundwork has been laid to allow us to really create this deep pipeline of opportunities that you see here. There are a couple of pref opportunities on here, and I did have the opportunity to join on a few of these IncomePlus webinars to talk about this portion of the presentation, the pipeline. I was looking through some of my prior notes. I think the last one I was on was maybe in December or January. And lo and behold, 2 of the pref deals that are on this pipeline were on the pipeline then. They are the 2 projects that we've been working through a 9 to 12 month period. I'll cover them here briefly in a second, but it's been a long process. We've stayed, with our developers, and it's really these 2 deals are illustrative of the challenges of expediting, the development timeline in today's environment. So first up on this list is a project here in my backyard in Charlotte. It's located in one of the most proximate suburban markets in downtown. It's a great bedroom community, vibrant, self-contained downtown, great quality housing stock, quality schools, barriers to entry, all the things that we look for in very strong development sites. This is about a 10 to 15 minute drive to Charlotte International Airport, in about 20 to 25 minutes from uptown. So pricing is due back from our general contractor this afternoon. Actually, we've been waiting for about 6 weeks to get updated numbers, given all of the complexities in pricing, and then also supply chain disruptions in the construction market. We'll be very intrigued to see where these numbers come back, and we'll know in the next really week or so if this project's moving forward to a closing, which would be in the next 30 to 45 days. The project is shovel ready, it's permitted, designed, ready to go. So the only issue would be to negotiate a GMP with the general contractor and secure our construction financing. The project in Orlando, as I mentioned, this is the $9.7 million pref commitment. This is one of those deals that's been on the pipeline for nearly a year. Projects located in an Orlando submarket that we have a significant amount of knowledge as we pursued a number of opportunities, both acquisition, development, and pref over the past 12 to 18 months. But really like the product and the basis. It's being built by a developer who's engaged in GC that we've been following all around the Sun Belt. So hoping again that this one comes to fruition in the next 60 to 90 days. Similar with the Tampa opportunity, this is the one that's been on the pipeline for almost a year. Same development partner as the one as our project in Maple Street Lofts. They've actually started construction on the project, which was the same situation that existed when we came into Maple Street with them, where we will fund our commitment while construction's underway. Looks likely to close in the next 60 to 90 days. The Jacksonville and Tampa build to core opportunities. This is with a new development partner to Origin, a very seasoned, vertically integrated developer. They have in-house construction. They've done a lot of conventional and student product really throughout the Sun Belt. Really bullish on the submarket demographics of both of these opportunities. And our partner, through their extensive sub-relationships, has been able to achieve some very attractive pricing on both of these opportunities, certainly relative to other ones that we've seen in the marketplace. So we're excited to move these forward. This would mark our first investment in Jacksonville, by the way, which is one of our approved expansion target markets. And the post-COVID fundamentals that we've been monitoring in Jacksonville have been exceptionally strong there, and also in the Tampa location as well. Those potentially are on track to close as we're working through due diligence in really the next, I'd say, 90 to 120 days. The first of the Phoenix deals on here represents the opportunity to partner with Geffen, who I mentioned before, a Houston-based developer who we have an existing fund asset with, the Haven and Mansfield project. We've also invested with them on a market rate development deal in Houston, which is a Fund 3 asset, Haven and Bel Air. They performed exceptionally well on both, as I gave a quick update on Mansfield earlier. But as I mentioned, we over the last quarter or so, we have finalized a programmatic development venture with them, whereby we will participate with them as a co-developer and have the right of first refusal to provide limited partner capital in these opportunities once we work through due diligence. So this Phoenix opportunity would be the first of a series of potentially 5 to 6 deals in our pipeline with them. This particular project in Phoenix is located in the Tempe submarket near the campus of Arizona State University and effectively across the street from a light rail station. So we're going through due diligence. We will be committing to at least a co-GP position with them on this opportunity, but has the potential to be upwards of $15 million of total investment. And then lastly, the other Phoenix opportunity is located in Goodyear, which is in western suburban Phoenix. And Tom Briney, our colleague who's based in Denver, has been relentless in his pursuit of opportunities in Goodyear. This would be, I think, the 3rd term sheet he's issued on an opportunity there. Really love the submarket fundamentals. Our proprietary AI tool has suggested that the forecasted rent growth here in this submarket is off the chart. Upwards of 5 to 6% forecasted rent growth annually. So very excited about positioning ourselves here in Goodyear. Should know in the next probably 30 days or so whether or not this becomes a live opportunity. I think we're on to the next slide, which would be highlighting the newest fund investment called Charlotte Avenue. This was on our pipeline for a number of months. It'll be moving off the pipeline effectively next week, as we are scheduled to close on Wednesday. And as Michael mentioned, this will be our first build-to-core asset in the fund, and with several to follow as I just moved through the pipeline. But we're extremely excited to partner with our development partner here, PDG, which is a new partnership at Origin, but has the ability to really expand our relationship strategically throughout the country. And similar to Geffen, similar to some of the other developers I mentioned, although Geffen is vertically integrated, this group also has in-house general construction as well. So they're able to achieve some very attractive pricing for this particular project. But it happens to be located within about a mile of where our Nashville-based colleague, Kyle Verhassel, lives. So he's got intimate knowledge of the surrounding amenities in the submarket, including L&L Market, which is a 20 different retail options, bodegas, bars, restaurants, so on and so forth, high-end retailers. So really great area amenities for the eventual residents of this project. And Publix is working to their approval to open a location about a block away, which is great news. So now, residents of the project here in West Nashville will have the opportunity to really have a self-contained neighborhood between grocery and plenty of entertainment and retail options near L&L. The amenities for this project are going to lead the submarket. We've got some great plans here for a spacious courtyard with a pool, a 2-story fitness center, working lounge for co-working booths, and then a 2,000 square foot sky deck and lounge with great views of downtown Nashville. So very excited to kick this off and for this to represent our first build to core investment within the fund. I think I'm getting at the end here of the presentation here, Michael. Actually, I will cover this section here on state of the market. I'm not going to spend a ton of time on operational performance. We did highlight that at several points throughout this discussion, but I will say, high level, and we get into the statistics and data later, more granular, but our target submarkets that we have strategically selected over several years and now have been validated through a very detailed data-based artificial intelligence machine tool that or machine learning tool that we built has suggested that we're in the right locations, and these markets have seen significant in-migration flows from folks that have lived in the north, and particularly in markets like Phoenix and Las Vegas. You're seeing the California immigration trend really in full swing. So what this has led to, and I mentioned before, Austin, of the markets that we're invested in and also tracking new opportunities on, has been one of the leaders in the last 60 days in terms of its rent growth. And we're enjoying that in real time with the performance of our Madison asset there. So 20% plus or minus rent growth, Austin is observing really in the last 60 to 90 days, as all the job announcements that are have been announced in the last couple of years. Many of the facilities are starting to open. They're hiring new folks that are moving to the marketplace, and then there's just been a complete swing of in-migration trends from, as I mentioned before, other locations throughout the country into this market. And there's a genuine lack of housing in Austin and many of our other Sunbelt locations. So we expect these strong rent trends to continue for the next few quarters. I'm not sure this is sustainable. I don't believe that we're going to see double-digit quarter-over-quarter rent growth for the next 2 years. But I think we position ourselves strategically in that we are really focused on kind of the middle price point in our markets. So there is the potential for future headroom rent growth. We're not necessarily playing at the class AA high-end percentage of the marketplace where you're looking at $2,500 to $3,000 rents. We're generally playing in the $1,500 to $1,800, in some cases a little bit less, a little bit more, but a very affordable price point for our underlying demographics. I'll cover on, I'm going to jump to construction costs here quickly. The topic du jour across our entire industry, and certainly within Origin since the start of the year, has been lumber pricing. It started before the pandemic in the $300 to $400 range. Going into the start of the year, as I mentioned, our project in Dallas, and we were staring at $600 to $700 lumber. And really over the last 90 days, we saw an absolute meteoric rise to about $1,600 per 1,000 board feet, just to use the index that most folks in the industry quote. We have taken the position that we are not going to purchase any of our lumber to the extent that we don't need to. We've been monitoring the futures daily and watching what's been happening there, and we've been very fortunate that the futures have gone our way. And really this has happened, a lot of this relief has happened in the last 30 to 45 days, and in some cases in the last week. Happy to report that lumber, as we sit here today, the spot price is about $600, again down from the peak of $1,600 about 75 days ago. And the futures are now pointing to somewhere between the $500 and $650 range. So it's starting to kind of settle in this, what we think is more of a normalized range of about, call it low to mid 600. So just to put that in perspective, a number of these build-to-core opportunities that we've underwritten at about $1,300 to $1,600. So we were using peak pricing in our models when we were approving opportunities, and also adding contingencies on top of that. So when we go to buy out our lumber in the next anywhere from 4 to 8 months, depending on the project, PDG might be faster. We may buy that out in the first 30 days, but we will see potentially upwards of $1 to $3 million of savings per project that we've underwritten. So substantial movements to the positive in the pricing market. I'll finish off on construction costs by saying, while we're seeing abatement on lumber pricing, we are seeing some of the other line items in our construction budgets. Some of the divisions are increasing, whether it be the challenges that some of the electrical and plumbing subs are finding labor, appliance shortages are causing some increases, but overall, supply chains are starting to normalize slightly from where they were again 6 months ago. But we feel confident that we've underwritten between our lumber contingencies and our additional project contingencies at a level that we will be able to achieve when we go to buy out our projects. Lastly, borrowing costs still remain competitive. We're getting very attractive construction financing in the marketplace, 60-65% loan to cost. It's recourse, which our development partners are generally providing. That's a low 200 spread over LIBOR. So call it 210 to 230, 240 at that 65% of cost. So plenty capital, debt capital out there that's anxious to finance a number of our projects. So that's it for me, Michael. I know I'm a little bit long, but I think we're ready to move.
Oh, that's okay. A lot of great information here. So here, my camera, I have a technical difficulty. Hang on 1 second. I got to turn this thing back on. Shuts off on me after a while. All right, there we go. So Dave, I'll give you a breather for a second, start to answer some of these questions. And I think our presentation was a little bit longer than we expected, but we're not overwhelmed with questions, so that's a good thing. So the first, the questions that were emailed in, what we did is we bucketed these into themes, and interest rate, just the fear of rising inflation, what's going to happen in interest rates was a big topic. So, the simple thing, and I say this on other webinars, we don't know what's going to happen with interest rates in the future. Is there, but what do we do from a risk management perspective? And if you look at our portfolio and the way it's set up today, we don't have a tremendous amount of exposure in the fund to interest rates, because our preferred equity is generally 12-13% in yield. So that's well above, you're talking about 9, even 1,000 points above where the 10-year treasury is, or 1,100. So that's more than enough to meet, an inflationary environment. And those should not be impacted, even if we see the 10-year go up to 2, 3, 4, 5% in that case, because they're more short-term in duration. When these projects get finished, we get paid off. And in terms of our common equity portfolio, we have very good debt service coverage right now. And, if we look at an inflationary market, one of the reasons why we're building a build-to-core is because we can build the higher cap rates in the future. And so what we call a return on cost, which might be a 5, 5.1, 5.2, that is a cap rate in the future that we're developing to. And the reason why we are not acquiring brand new properties today, Dave was talking about borrowing costs. Yeah, we can get debt at 65%. The problem is it's going to cost you 3, 3.25, maybe even 3.5, depending on the property. And when you're buying properties at a 3.7 cap, 3.8 cap, 3.9 cap in some of these markets, you don't give yourself any cash flow in the property whatsoever. So, there was another question that came in. What are we doing to sort of position ourselves, in the portfolio against exogenous shocks in the future? And that's the best thing we can do right now, is not go out and buy core plus and value add with assumptions that we think are priced to perfection. And when you're in sort of this core plus environment and cap rates move slightly, 25, 30, 40 basis points, you might see your invested equity declined by 20%. And that's not a game we want to play whatsoever. So we are still in a protected position in the capital structure in our preferred equity, and we're doing more and more build to core with the idea that we're going to hold those long term. But I will say this, that I was listening, I read an economist, his name is John Malden, fantastic, I love his stuff. And he just had an investment conference. And what we see on the horizon is everybody's talking about inflation. Most of the economists were of the same opinion at this conference, that look, they believe this is going to be transitory, and what you have to look out on the horizon for is actually deflation. I'm not saying that there is going to be inflation or deflation. It feels like there's inflation today, but we also have to be looking at a deflationary environment in the future. And right now we are a savings economy where the baby boomers are getting to an age looking for yield, and that just continues to drive down the price of 10-year treasury and drive up the price of assets that are generating yield. So great question. And, it's something that when we talk about managing risk, we're putting as much fixed rate debt on to our common equity properties as we can, but you always run against the risk of maturity at some point in time. But I will say Austin is a good example, because Austin, the debt there, Dave, is beyond 30 years, right?
Yeah, correct. That's a home run.
So, yeah, and that's a big part of our common equity portfolio. So thank you for your question. So is that enough of a breather, Dave?
Yeah, thank you. I'll take 1.5, maybe 2 of these questions here, because this one's kind of down the strike zone. But broadly speaking, do you expect continued cap rate compression over the next 12 months, and more specifically in Phoenix, Arizona? Phoenix happens to be, no pun intended, the hottest market in the country. Also temperature-wise, but certainly from a capital perspective, there's more capital chasing deals than, frankly, in any of our other markets that we see right now, because capital sees the things that we do, which are phenomenal underlying demographics. And as I mentioned before, the continued out-migration from California. The job growth there has been exceptionally strong. It's an affordable market, great university driver with ASU that partners well with surrounding businesses. So it's, yes, we believe that fundamentals will continue to improve. And I hate to say this, but I actually would believe that cap rates could compress further in Phoenix, which right now is crazy to think that it's in the low to mid 3s. I've heard last week, not a transaction that we were bidding on, but a project in Austin just went sub 3, had a 2 handle on the cap rate. So that's another example of, I would say that's cap rate compression we witnessed in the Austin market, for example, in the last 60 days. I think there will reach a point where cap rates cannot go lower. Michael just touched on this. You get to a point where you have what's called negative leverage. Cost of borrowing exceeds the cost of your going in cap rate, and you have to grow your way out of it. So I think capital flows will continue to move into Phoenix. We could see it tick down, and then I think we'll probably reach a point of just equilibrium. And I'm not sure we can go much lower on the cap rate side. I'll finish with the question about housing, because housing and how that translates into the single family housing into the rental market. I'll go back to Austin and use that as an example. Austin has been, I think I've seen this stat before, but the leader in terms of home price appreciation in the country for the last 20 years. So the single family market has been on fire in Austin. The rental growth in Austin up until this last 20% pop that we've seen in the last 60 days has been somewhat flat because there's been a fair bit of supply there. So I don't think that there's a lot of correlation. I use Austin as a great example between following the housing market and following the rental markets, because there's fundamentals that exist in each. I will say this categorically, we are undersupplied in all of our markets for all housing, single family and rental. Therefore, I do believe that we will continue to see strong growth in both pricing, with the caveat being if borrowing costs for home buyers continues to increase, qualification standards increase, or home builders continue to underproduce, which has led to the skyrocket in single family home prices. So they're not necessarily correlated, but we do track both and look for trends.
Yeah, and the other thing that's going on with the single family home market is the millennial generation is coming of age right now, where the peak population is at around 32, 33 years old. That demographic is moving through. That also happens to correspond with the highest percentage of people who buy homes. 32, 33 is sort of that age. And the challenge is now you have this massive demographic moving through society, but you have no homes on the market. And that's why you're seeing single family home prices go through the roof. There's been tons of articles about people bidding on 10, 20, 30 homes, paying way above ask. And put it in perspective, today there's 1 million homes on the market. And at the peak in 06, there were about 3.5 million. And so you have this supply demand demographic that's going on that's just creating a huge tailwind for single family homes. But the point is that there's not enough homes out there for people to buy. So they're going to be forced to rent. So it's not either or, it's really an and, because this is actually a hangover from the 08 recession, where we just haven't built enough homes out there to keep up with the supply. The lumber mills are lower capacity today than they were back in 08, and we have a tremendous amount of construction going on. So I think what we're going to see over the next few years is that we're going to, both single family homes and rentals are going to continue to do well. All right, so a quick question I'll answer. Will this fund close? And the answer is, it might, but not today. It's something that we look at because as you get up to scale, you have to make sure that you can continue to produce returns. So where we are today at $150 million, not even close. When we get up to $400 or $500 million, maybe, and we'll look at that when we get to that point. But keep in mind that this development bucket that we put in there, that's kind of the part, what I'll call the frontier sleeve of the portfolio that will continue to juice the returns of the portfolio. And then it becomes managing the preferred equity side of the portfolio. But the bigger the fund gets, the more the fund is exposed to sort of the core properties themselves. But that's the nice thing about having the build to core in there, is that you're constantly juicing returns through those development side. But it's not going to close overnight, not in the next week. I know, maybe we got this question because we just closed the QOZ fund without warning. Totally different environment, this fund versus that fund. But thank you for your question.
I don't know how much more time we want to take, Michael. I think we're a little bit over an hour, but I'm happy to take one or two more.
Yeah, knock out some of these, Dave, just maybe with some really quick answers. We'll just do the lightning round here. How about that?
Yeah, I mean, real quick one, where are we in the capital stack and private equity deals? We're generally playing somewhere between, on the very low end, 75, on the high end, 85%, but our target, position within most of the stack is 80%. I would say that generally speaking across the portfolio, we're probably averaging about 78 to 80.
Okay, next question. Does the federal government emergency rental assistance program affect Origin's properties? That's not something I can quantify, but I have to imagine, I believe it's about $50 billion in renters assistance coming to different households that can prove it, who need it, get it. It's not, we don't track that, the source of income from the renter itself. But if that $50 billion weren't in the market, I would imagine our collections would be, slightly lower than they are today. But generally, I would say that it's probably a negligible impact.
Easy one. Are you considering Utah, Salt Lake, and Provo as potential target markets? We will be out there as a team in Salt Lake and Park City next week, actually 2 weeks. So absolutely, we've got Tom Briney on the case. He's out there cracking into that market as we speak, looking at some live opportunities. So it is 100% an improved expansion market.
Yeah. This first question came in at 10:20. I think we answered this, which is, have you changed anything in your strategy? Yes, we talked about the advantage of a multi-strat fund, the reason why we're not buying core and we're focusing on the preferred equity and also the build to core part of the 20% frontier sleeve. And then lastly, do you fund pre-development costs prior to GMP, land close, et cetera? The answer is generally no, but we're not opposed to it. It's all a risk reward. And in today's market, it's incredibly competitive. So if we need to fund $200,000 or $300,000 or $400,000 in pre-development costs to get a deal and get it to the closing line or the finish line, then that's something we might do. It depends. There's a lot of points at which you have the decision of go or no go along that spectrum when you're funding pre-development. But generally, we're never going to come into unentitled properties with this fund. We don't guarantee loans either with this fund, so we don't provide that kind of support. Okay, and then last one, I'm going to take this, Dave. I guess somebody was asking about the 6% target. That's only the yield in the fund. So the fund is actually a 9 to 11% target. I should have maybe emphasized that. And that's made up both of a current yield of 6% and what we're targeting, which is about 3 to 5% of appreciation per year that shows up in the unit price. And again, if you're an investor and you don't need the income, you can choose to go into our DRIP program, which is a dividend reinvestment program. And that just shows up in higher and higher net asset value on an annual basis. So, okay, that is it. Thank you very much for your time. Dave, it was great having you on the webinar today. Appreciate your insight and knowledge. It was fantastic. If you are interested in investing in this fund, I would ask that you just reach out to our investor relations team. You can reach them via our website, or if you've already registered, you've probably gotten an email from them. You can go to them directly. They will help answer any questions you have and shepherd you through the entire process. Now, if you are a Fund 3 investor and you want to reinvest into the IncomePlus Fund, you can also reach out to the investor relations team and they will help you do that. And what that means is that you will not receive distributions in your bank account. Those will automatically get reinvested into the IncomePlus Fund. So we really appreciate your time today. We will see you again in 2 months, and thank you for attending.